Okay, so we can begin the webinar now. For those of you that don't know me or this is your first time on this webinar, my name is Cole Braithwaite. I'm a commercial real estate agent specializing in investment sales throughout Ontario, working specifically with private capital or private families in selling their commercial real estate. And today's presentation, what I will be covering is the Q1 2024 GTA market update, and I'm going to cover some of the activities, what we're seeing, and some of the trends going forward. So first, to start off here, what we're going to be covering today in this webinar is, I'm going to go over the total market activity. So I'll take into consideration all asset classes in the GTA, what we're seeing in terms of sales and the number of transactions. Then I will pare it down specifically for the retail market. Many of the owners I work with own a lot of retail assets or commercial retail assets, as well as then I will also focus on the industrial market also as well, and just go into a little bit more detail specifically for many of my clients that own those asset classes as well. The new capital gains inclusion rate tax impacts, I'm going to share with you kind of what is going on with that, how I see that affecting the market. I'm sure many of you have probably heard it throughout the news in terms of the new the new federal government budget and what they've proposed. So I'll share how that may impact CRE going forward. And then ultimately I'll tie it back into what this all means for you in terms of if you're looking at buying in today's market or you're looking at selling. We'll focus on all of that going forward. So if we look at the total market, and I'll pull up these year-over-year stats in terms of the sales volume. Currently, we're down about 33% in terms of the number of volume. That's down from $4.5 billion what we saw in Q1 in 2023 to about $3 billion now. What we see, so we've lost roughly about $1.5 billion worth of transactions on a year-over-year basis. And this encompasses the entire market. So this is retail, this is apartments, residential land, office, land zone for commercial uses, as well as hotels. So I factor that all into the GTA and what that kind of represents in terms of the sales. On a quarter-over-quarter basis, we're obviously starting to see a trend of it starting to diminish. If we take a look here, Q4, we saw $3.7 billion worth of transactions. So if you factor it in, and this chart doesn't show, but we went from 4.5 at the beginning of last year to 3.7 by the end of this at the end of last year, and now in the first quarter we're down to 3 billion. So the market is starting to slow down, and obviously this is a big impact on how interest rates can affect the market, and it's affecting what this data doesn't show is that it's affecting certain asset classes more than others, and as we parse it out a little bit more, you will see. But overall, in terms of market share, industrial is leading the way with 29% of the entire volume of market share of sales volume, led by residential land. And this is typical. We'll see in any given year, or really in any given quarter, just because of the size of the industrial products. They tend to trade at a higher average price point than any other asset class, and similarly with residential land. If we just look at the overall market transactions wise, again, that's down about 8%. So we saw 334 deals completed in Q1 2023. We only saw about 307, so that's slightly down. On a quarter-over-quarter basis, 25% down, where we saw 412 deals completed at the end of the year. So what you'll notice is that the final quarter of last year, it's higher than what we saw in the beginning of 2023. And the reason being is that mainly a lot of transactions end up, many buyers or sellers like to close at the year end just so they can get in for tax purposes or different reasons. So historically and seasonally, we'll always see more transactions completed then, but sometimes it skews the data and doesn't mean that it's necessarily indicative of the sentiment in the market. Overall market share in terms of transaction, retail does represent the most, and that's mainly because many retail transactions are smaller in size. I'm talking sub 3 million. So there's a lot more activity. If you think about the assets that are on the Queen Street or Yonge Street or Danforth or Bloor Street, those smaller types of retail, those are the ones that make up a bulk of a lot of the transactions and sales going forward. So if we focus in and parse it in a little bit more specifically on the retail market, what I like to do again is take a look at retail sales of properties over 10,000 square feet. So I parse out the smaller ones and focus on some of the larger multi-tenanted stuff that's transacting. And what we're finding in the market again, it's just overall, and you're going to hear this, overall, the sales volume activity is just down. We're down 21%. If we take a look at the graph prior to 2019, we saw a big uptick over COVID and peaked out really in 2022 and 2023. And then we've just been on a downward slide for the last really 2 years. And what we see is that, you know, we're down 21% from last year, so we were at $418 million worth of transactions in 2023, and now we're down to 331 this year. So there's just a gradual slowdown of activity due to the interest rate and the cost of capital that's affecting that. How that is translating into the transactions wise is that it's interesting that transactions, they share a bit of a choppy sort of graph, and they're not always indicative. On average, we'll see in any given quarter above 10,000 square feet, anywhere from 14 to 15 deals completed. This quarter, we saw about 64 deals, or sorry, 18 deals completed. That's a 64% increase from last year. So the sales volumes are definitely higher than or around probably the pre-pandemic levels. And we're starting to see in terms of the number of transactions and around that mark. What that tells me is that we're seeing the average sales price go down per transactions, or the smaller deals are the ones that are actually getting done. I have a chart that I'll actually share that a little bit more in detail for you to get an idea. I'll quickly skim through just on a quarter-over-quarter basis and just the trend line. So from Q1 2023 till now, if you take a look at the graph, if we parse out some of the major deals, so what made Q4 really big is mainly 2 transactions that represented 50% of all deals, which are about $350 million. And that's why this is a little bit skewed. But if we parse out those transactions, the market has just been pretty much anemic for retail in terms of the slow pace of volume and such. And we're down 62% from Q4 to kind of give you an idea. And same thing with transactions. They've just been slower on a quarter-over-quarter basis each time. If we jump into the industrial market on a year-over-year basis, I'll just share that industrials, again, has been the top performing asset class really in the GTA, where there isn't enough industrial assets or supply to meet the demand of what we're finding out there, whether it's for users, for lease, or for sale. So the activity is definitely pushing up a lot of the transactions or making it stable, even in the face of higher interest rates. I like to take a look at a snap bracket, and I call the middle market, which I deal with within 10,000 square feet to 100,000. Of course, there's a lot larger sales transaction, a lot of institutional players, but I've stripped those out to really get into the meat of where all the transactions are. And they're up 16% from last year at $548 million worth of deals. If you take a look at the transaction number wise, again, we're up 15% to about 45 deals. So on average for industrial, yeah, we see about 35 to 40 deals a quarter each quarter, and we're up from what we saw last year, and definitely way higher than the pre-pandemic levels. Just as we, and this is the typical trend of what we saw with industrials, that as we went into the pandemic, the supply chains of the demand for bringing a lot of products online, warehousing, as well as a lot of onshoring of a lot of manufacturing and a lot of work has really pushed pressure on the supply, and that's what we're seeing drive up pricing and demand for the assets. So it's definitely going to continue. My prediction a lot with it is that I think it's going to stabilize a little bit. It'll still perform quite well, but I don't think we're going to see the crazy sales volumes numbers that we saw in 2021 and 2022 going forward. And then on a quarter-over-quarter basis, I'll just share here as well. This tends to be quite stable. Again, Q2 similar to Q4 in the retail, some large transactions which skew the data here, but we're up 14% in terms of the sales volume from last quarter just to end the year. And we're up 18% in number of transactions to, again, 45 deals from last year. So on average, 45 deals we complete each quarter with an average of about $580 million of transactions. So that gives you kind of the sales volume of what's going on, and industrial definitely seems to be continuing to perform. Like I mentioned, what I've been doing ever since the interest rates increased, I wanted to track the difference between interest rate sensitive price points of what I've started to notice as maybe as a theme that's going on. The theory goes is that as we go over $10 million, financing becomes a much more of a requirement in terms of completing the transaction. And I anticipated less deals would be done because financing would be more required, as opposed to the smaller deals, really sub 10 or even really sub 5 million, because of the equity availability of cash, buyers could get through that and we'll see a lot more deals. And how it's playing out right now, specifically for retail, we saw 8 deals that were completed below $10 million in comparison to 6 last year. So we're up in terms of the same number of sales volumes for smaller deals for retail. For industrial, it really didn't stand to change. We saw 22 deals completed this year. In comparison to last year, it was only 23. So we're slightly down by 1 transaction. So it's roughly negligible. What's interesting, and if I go on to the above 10 million number, is that, again, like I mentioned before, retail represents larger transactions, or sorry, industrial represents a lot of larger transactions. So you're going to see a lot of deals north of 10 million. So it does skew the data. Just to give you an idea, industrial had 18 deals last year, has 18 deals this year. So they seem to keep pace. And what's interesting enough is the same thing for retail. So there was 8 deals last year and in Q1, and now there's 8 deals this year in Q1. So they've stayed about stable. So we're starting to see a trend line, and as interest rates take shape, how it somewhat affects the markets going forward. So it gives you an idea. So if I skip over to our new capital gain. So earlier this month, or early last month, the Canadian government, federal government, came out with their new federal budget, with a series of things designed to impact housing and to improve the economy, as well as at the same time looking at implementing new tax on capital gains. So to give everybody kind of a buffer, was that we in Canada, we have a 50% inclusion rate on the gain or the profit that is made at the end of a sale or of a transaction. So previously to this, with 50% of the gain would be taxed at your current income rate. Typically, with a lot of these larger plazas, because of the profits would be so large, it would push you into the higher income bracket in terms of taxation. A little bit of history, and many of you were, maybe aware more than me, but in 1972, there was the first year where we had a capital gains introduced. We didn't have one prior to, and that started at 50% inclusion rate. And that lasted all the way till 1988, where we got up to the 66% where we are currently at today. And then in the 90s, we went even higher, in 1990 to 75%. And then that lasted for roughly another 10 years, 10, 11 years until 2001, where we now dropped down to the 50% inclusion rate, where we realistically lasted for the last 22 years or so. Now we're back up to the 66% number, which has a lot of owners, in flux on what that means going forward. What I did is, as a survey for many of my clients and owners, I took a survey and asked them a series of questions relating to around these changes and how that may affect their decisions. And the results were quite interesting. 66% of owners felt that this commercial real estate market in the GTA would be impacted by this change. So they do anticipate changes going on. They weren't specific in terms of what they saw, but they do feel that there's going to be an impact in terms of the activity. But what's interesting on the other end is that 66% of them also said that, or the vast majority said that, it's not going to affect their investment decisions. How I interpret that into is that many of the owners right now, and what I'm predicting, is just going to slow the amount of activity even more. If you think about it, if I've owned an asset for 20, 30 years, which many of my clients have, they've paid off their debt, they have a low basis on it. If they were to go to sell the asset, there's going to be a large capital gain that they're going to have to pay. And this has been the number one pain for many of them, because they don't want, obviously we want to keep our money as long as possible, but we don't want to pay the tax unless we absolutely have to. And all that's going to do is just push that decision off to a lot longer. So we're going to see less sale transactions occur as owners wait and hold, hoping that maybe in another year and a half, when there is an election and maybe a potentially change of government, that the interest rates may change. I'm skeptical to think that may happen, just because historically we've been at these higher numbers, this higher inclusion rate, even higher. So that may or may not happen. The date that's scheduled to have it take effect is June 25th, and it hasn't been fully voted in yet or confirmed yet. But all assumptions is that it is going to pass, and then we're going to be subject to that. And what I can see is, and if we're all familiar with what happened in the 90s in terms of the sales activity and the recession that real estate really took a hit over, I think the higher taxes from talking to others and that were experiencing it did play a part in prolonging the recession and the recovery of real estate, because there was just less incentive to do deals and transactions and less reasons to work through this. So overall, I don't think it's a positive for it. I just think most owners are just going to hold on longer to it than make a decision going forward. And that's what I anticipate how it's going to play out realistically in the market. If we go on to, well, what this means for you, and I'll specifically take the position if you're a seller. Number one, if you're considering selling your asset class or your asset right now in today's market, even in the face of this, there is still good, strong demand for retail properties or industrial properties. The reason being, there's not much available for sale. So that's why we see a lot of skews in the data, and that's why the volumes are slower. There just isn't that much retail assets or a lot of assets that come available for sale, and as a result, that's why we see a low sales data. But there is strong demand based on a lot of the listings and the activities that we get. We get multiple offers on properties all the time that come to market that are price attractive. There's still strong interest, so that does play into a positive for you. So I don't really anticipate values crashing or going in a negative direction. I just think we'll see slower amounts of deals. So if you're interested in selling, then it could be an opportunity for you. What I'm encouraging a lot of owners to do is be flexible on deal terms. As interest rates play a more and more impact on sales, it's going to be important that sellers work with their buyers to ensure that they're able to get deals across the table. I think it's the biggest challenge what we're working with on it right now. I'm working on a couple deals that are in that position right now where financing is an issue and a challenge to get through. So working with them on flexible deal terms will help. If you're open to even giving a VTB, that can make things great. The anticipation is that over the next 2 years, interest rates are going to go down. So that gives them, the buyer, an opportunity to refinance into a lower market going forward. So that's something to consider. And then also what I say is put your best foot forward. What that means is that present your asset in the best light it can. If there's any improvements needed to be done, if there's any cleaning up of any leases or financials or anything that can make the process easier for a buyer, that's what we're going to encourage to get deals done. If a deal is like pulling, if the deal is challenging and it's like pulling teeth in terms of getting the information out of the seller or making it easy, buyers are just going to move on as there's less incentive for them to work through that. So my encouragement and what I'm seeing what makes deals easy is if the owners are transparent, they have all the information available, it just makes the job that much more simple. You're also able to get a higher price just by making the process a lot smoother. On the other end, if you're a buyer, what I'm encouraging is widen your geographic area. I know many of owners that I work with, they like to focus where they're within their specific niche around their properties or where they live. And if you choose to open up your geographic area, even just slightly outside the GTA, there's less competition for a lot of those assets, and you're going to be able to get a lot more favorable deal terms or potentially favorable interest cap rates on your investments. So it can be a strategy to take advantage of. If you're in the position and have a lot of cash, what I'm suggesting a lot of buyers is if you're able to move quick on deals and get great pricing, pay all cash for it with the assumption that if, again, interest rates are going to reduce over the next 2 years, refinance into a new interest rate environment and take it out. But utilize your cash as an ability to move forward and make quick decisions on properties so that you can take advantage of a market where there may not be as much activity for particular types of deals going forward. And you are the prize at the ball per se by offering that. So something to think about. And then also look for sellers with high equity positions. Why that's important again is that sellers with high equity positions are more able to provide favorable financing terms, maybe provide VTBs, so that in a short term you can cash flow the asset, you can carry the asset while we wait for interest rates to decrease and then refinance them out later. And the higher the equity position, the more favorable they're going to be. Also, on top of that, obviously, if there's an increase in the capital gains rate, they're going to be less reluctant at selling and having that huge capital gain event in that particular period. Sometimes adding a VTB where you can do up to a maximum of 5 years and defer some of that tax over the years may be advantageous to a seller for for them to consider. So things to think about in terms of strategies, in terms of helping you be able to buy and navigate in this market is what I would say. So that concludes the end of the presentation. Really, I took just a general deep view on our retail, industrial, and the overall market. But if you have any specific questions as it relates around your asset and want to go into deep, I can take an analysis of your property and give you some more insight specifically that could be relevant to you. So reach out to me through email, or you can give me a call, and I look forward to continuing with these presentations and keeping you guys up to date on the insights going forward. So until next time, take care.